Most people fear investing in the stock market, opting instead for safer investments like real estate or savings accounts. But what they actually don't realize is that this fear often comes at a cost, missing out on the very asset class that has historically built more wealth faster than almost any other if you know how to play the long game. Hello there, this is the Value Investor. I help people save and invest intelligently. In the next few minutes, we'll break down exactly how this works, why it's not as risky as you might think, and how you can start investing with confidence. Let's break this down. We're going to get very, very simple so that no one gets left behind. What is the stock market? So, the stock market is a marketplace where shares of companies are bought and sold. So, when you go to the shopping center, that's how the stock market is. It's like a shopping center where people buy and sell shares, and these shares represent ownership in a company. So investors buy shares to participate in the growth of the company. So, for example, right now, AI is taking off, and some people want to get involved in that. What do? They go and buy shares in a publicly listed company that is into AI. The reason why companies issue stock is to raise capital for growth, expansion, and operations. So, this is an alternative to taking loans because the company can go to the bank and get a loan, but loans sometimes tie a company down because they come with certain conditions. So, issuing stocks gives investors a chance to own part of that company. And if a company makes a loss, they just tell them, look, guys, we made a loss. And that's how it goes. So, sometimes companies will opt for issuing stocks rather than issuing debt or loans. There's a lot of money to be made in stocks. So, you make money by selling shares for more than you actually bought them. And there are people who day trade on the stock market. They're called day traders. I don't recommend that beginners do that. And then there are dividends, which are periodic payments from company profits. And some people do what is called dividend investing, where they go out there, look for companies which pay the highest dividends. It's called dividend yield. And then they invest in those companies. Then they're getting periodic payments from company profit. And then you've got long-term appreciation from business growth, which is what I tend to go for. So this happens when you hold that stock for quite a long time, 10 years minimum to even 20, 30, 40, 50 years sometimes. This is what I always tell people on my channel, is that when you are buying a share, it's not just a piece of paper. When you are buying stocks, you are not just buying pieces of paper, you are buying a share in a real business. And you must be interested more in that business and how it makes its money for you to make your money. So there are several types of stocks. The most common one is called common stock. Go figure. So yeah, it's got voting rights and potential dividends. Then you've got preferred stock. So preferred stock is a hybrid between stock and debt, and it's got so the hybrid nature of preferred stock is that they have to pay those fixed dividends before um, common stockholders can get anything. So preferred stock, that's why they are called preferred, because they have to pay their dividend, and their dividend, they have got priority over common stockholders. Then growth stocks versus value stocks. There are stocks which grow very fast, like your Nasdaq. Tech stocks, they grow quite fast, and their PEs are quite high. Normally, value investors don't go for stocks which have got high PEs and high valuation. There's that distinction between stocks that you've got growth stocks and then you've got value stocks. So value stocks are those stocks that are cheap, that you can get for cheap, and they are very cheap. They've got low PEs. This means that you're not paying too much to own a share in that business. Then you've got risk and rewards. There's a saying that goes, high risk, high return. You might know this very common term, and this is true because the higher the risk, the more the rewards can get. But also, the higher the risk gets, this also increases the odds of you losing or getting wiped out. This is how it works. So high potential. So there's high potential returns over the long term in the stock market, and prices can fluctuate in the short term, and this is known as volatility. So risk in the stock market can be addressed by diversification. So market risk is the risk that the whole stock market will crash, and that market risk is addressed by diversification. So if you diversify, you can actually reduce that market risk. Business risk is the risk that the business you've invested in might not do well. So this risk can be eliminated by doing thorough research, making sure that the company you're buying has got a strong brand, a strong moat, which can withstand headwinds. And then liquidity risk is the risk that you might not be able to sell your stock when you want to sell, and this is very low in the stock market, except you are dealing with penny stocks or some stocks that are not quite known out there. It might take you time to actually sell if you want to sell. You have been wondering, where do stocks sit in all this in terms of risk? So stocks, they sit comfortably in the middle, and personally, I am the middle of the road kind of guy. I like things that are balanced in terms of everything, really. So you've got your fixed income, that's your lowest risk assets, and then after that, so your fixed income or treasury bills, those are issued by the government. And then you've got commodities, which are gold and silver. They don't move much, but they can be an inflation hedge. And then you've got stocks. And then on your stocks, not all stocks are born equal. You've got your blue chips, you've got your mid caps, and your penny stocks. So the blue chips are the safest stocks. They are your tried and tested, your Apples, your Amazons, your Coca-Colas. And then your mid caps, these are companies that have weathered much of the storms in the mud pits there. So they are, your companies that are worth anything from 5 billion to 10, 20 billion. Those are your mid caps. And then your penny stocks, these are stocks that are still, coming out of the IPOs. They are, they trade for pennies on the dollar, and these are very, very risky. So when you're starting as an investor, I would encourage you to go for the blue chips, and then when you get more experience, you can then jump onto the mid caps. And penny stocks, I wouldn't encourage anyone to do that. Then after stocks, we've got private equity business and business sales. And these private equity is companies that are bought and sold off the stock market. And then there's the riskiest class, which is Bitcoin, meme coins, or NFTs. And these ones, don't touch these ones with a barge pole. Very risky and very dangerous. You are playing with fire. So how do you get started investing? You have to open an account with a broker. So brokers are on the screen, so you can see the one that I'm using is Trading 212. It's very cheap. It's got no trading fees, so I like that for Trading 212. So learn the basic financial terms and metrics. I'm going to be doing a video explaining some of these terms and metrics. And if you have anything that you want to learn, pop a comment down below and tell me which video you want me to do next. So start with small investments. Start with what are known as index funds. And Warren Buffett actually encourages beginner investors to start with index funds. If you don't know what index funds are, or you can find a link in the description down below to the video. So focus on long-term growth, not quick. So do your own research before investing. Don't just follow. Invest only what you can afford to lose and think like a business owner, not a gambler. Patience and discipline are key to success. If you've enjoyed this video, please give us a like, leave a comment, share with some of your friends who want financial freedom. And I will see you in the next one. Happy investing. Cheers.